Hey, good morning once again, options traders. Well, a theme that I carry in most of my videos is that there is no such thing as a good strategy or a bad strategy. They're just simply tools. And like all types of tools, there are times to use some and times to not use them. And that's really the way you need to approach options as opposed to being on the hunt for the absolute golden strategy that makes all the money in the world and never loses. That's one of the things that I hear from a lot of traders out there. What's the best strategy? But to really make the most of your trading and your decisions, you need to understand the different characteristics. So here's a good question for our group. Which options carry the most information? Now, the answer, once we reveal it, is a class of options that you're all familiar with, but this is going to be cast in a light that you've probably never seen before. And by understanding this aspect of options, it will help you to make better decisions. So let's go find out this whole idea of which options carry the most information. And before we do, please be sure to click like and subscribe. It is greatly appreciated and always helps to promote the channel. So to start off with, we have to understand this idea of certainty. Information only has value if it has the ability to alter a decision. And if something is certain, well, then it carries really no information and therefore no value. Why? Because everybody knows. So if I offered to sell to you some information about whether the sun will rise tomorrow, you'd probably say, thanks, but no thanks. Everybody knows that it will, or at least is about as certain as we can be. So you'd say there's no value in that information because it's close to 100% certainty. Now we could go in the other direction and I could say, well, for a fee, I will tell you if it will or will not rain in the Atacama Desert tomorrow. Well, that's the driest spot on earth, and I was reading about it. There are some sections that haven't seen a drop of rain in 500 years. So how much would you pay for that information, whether it will rain or not, in the Atacama Desert? You'd say thanks, but no thanks. So the thing to take from this right now is that if something is 100% certain, it doesn't have value. Again, knowing that the sun will rise tomorrow. Or we could look at it in terms of 0% certainty. So again, we have 0% certainty that it will rain in the Atacama Desert tomorrow. So it has no value. So the thing to see is that 100% certainty and 0% certainty are just simply two sides of the same coin. So let's now talk a little bit about uncertainty. Removing uncertainty has value. What's the maximum uncertainty? 50%. Think of it like a coin flip. That's the worst case of certainty or uncertainty that we can have. That's why it's funny when the weatherman tells you on television that there's a 50% chance of rain today. Well, that really tells you nothing. It's just the maximum uncertainty. If they were worth anything, they should lean a little bit to one direction or the other. Tell me it's 49% or 51%. So 50% is the worst case of uncertainty that you can have. So if you can remove half of the uncertainty, you're maximizing the amount of valuable information. And that's really the trick to understanding about which options convey the most value. So to do a demonstration, let's go back to the game show. I believe it was The Price is Right. So for example, contestants were shown several items. It might be a trip to Tahiti, a Cadillac, and a boat, whatever, and they would have to guess the value of these items, usually to the nearest thousand or maybe the nearest hundred. And the question that we want to explore here is, what's the best strategy for getting to the answer the quickest? And the answer is that you need to remove half of the uncertainty at each stage. So let's just do a simple example and look at one item. It would be the same strategy if we had multiple items, but I went to a Boston Whaler website and looked at I think it was a 26-footer, 300 horse engine, different accessories, and they said this was priced at $145,800. So let's just say that this is the boat that they're shown. And the game show would tell you some of the specifications on the boat to give you kind of a rough idea. So once you had this, you had to guess, let's say to the nearest $100, the value of this boat, and I think you had something like 30 seconds to do it in, but it was on a clock. Well, let's take a look at the strategies. Let's start off with the first one of what not to do. What you wouldn't do is say, I don't know, maybe how about 200,000? And the host says, no, that's too high. And you say, how about 198,000? Nope, too high. How about 197,500? Host says, nope, too high. And see what happens here, and every once in a while you would see a contestant that would do that, is they just are certain that their first guess is pretty close. So they're trying to just dance around this value until they can just zoom in on it. But the problem is that each guess removes very little uncertainty. To maximize it, we have to try to remove half. So here's what you would want to do. So your best strategy is to give it your best guess on your first attempt. Try to find what would be, let's call it the median, the middlemost value of all of these possible boat prices. At least try to get the magnitude right. Are we talking about tens of thousands, hundreds of thousands, millions? Just start there. Now it turns out that if the answer is too low, double it. And if the answer is too high, cut it in half. So even if your first guess is way off, you're going to find out that either doubling it or cutting it in half will get you to the answer the fastest. And that's because you are removing the most uncertainty at each stage. And so once a high and low is established, continue to cut the range in half. And what will happen is that each guess establishes a new high or a new low, but removes the most uncertainty. In other words, you are giving it the most valuable guesses. So for example, let's say that here's our contestant. Now remember, the contestant doesn't see the price. I'm just putting it up here so you can see how quickly we're converging to it. But let's say the contestant guesses 400,000. And I'm doing this as an extreme just to show you that the first guess almost doesn't even matter, as long as you at least have the magnitude right. We are talking about hundreds of thousands. The host says that's too high. Cut it in half, 200,000. Too high. Cut it in half again, 100,000. So in just 3 guesses, you've now established a floor, a minimum of 100,000, and a ceiling of 200,000. Now just continue to cut this range in half. There's a $100,000 difference here, so add 50,000 to the bottom here, and so we guess 150,000. And the host says that that's too high. Now we know the answer is somewhere between 100 and 150. That's a 50,000 difference, so 25,000 would be the halfway point. Guess 125,000. We're just adding this halfway point to the bottom. And so the host says, nope, 125,000 is still too low. But now we're within 25,000. Now here's where you have to be a little careful, because you don't want to start cutting things in halves and quarters and eighths and sixteenths and having to keep track of that in your head. So we've got a $25,000 difference here. Half would be 12,500. Let's just round it up to 13,000. Add 13,000 to 125 and we get 138,000. Host says that's too low. But now we've got a 12,000 difference. Add 6,000 to the bottom. So we guess 144,000. Host says that's still too low. But now we know we're within 6,000 bucks. Cut it in half again. Let's add 3,000 down here. 147,000. Host says that's too high. Now we're within 3,000. At this point, we might want to start splitting into halves and things like that. We could say we know there's the halfway point would be 1,500 bucks. So let's make it 145.5. Host says that's too low, but we're getting closer. So let's now just maybe guess 146. Host says that's too high, but now we're within 500 bucks. We know the low is 145.5, the high is 146,000, and this is usually where contestants will go 145.5, 145.6, 145.7, 145.8, and then they hit it. But the point to see is that really in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 guesses, we quickly zeroed in on a price that we really had almost no idea could be almost anything. So what does all of this have to do with options? Well, it turns out this is exactly what at-the-money options do for you. They remove most of the uncertainty. You see, to understand the options market, at least at a more of a philosophical level, the options market tries to resolve which options will be in the money at expiration. So think of it as though there's two lines that are forming, in the money options and out of the money options. And every day the market's trying to figure out which of all of these strikes are going to be in the money at expiration and which will be out of the money at expiration. So if we are looking at deep in the money options, we are near certainty. This is like the sun's going to rise tomorrow. People are saying, okay, well, that's not really telling me a whole lot about whether this option's going to expire in the money. I'm pretty sure that it will, so therefore it doesn't have a lot of value. Now, don't confuse that to mean it doesn't have a high price tag, in other words, a total premium. It might have a lot of intrinsic value. But remember, the true option value is the extrinsic value. So a deep in the money option is not going to have a lot of extrinsic value. On the flip side, if we go deep out of the money, we are also near certainty. We're certain that they won't be in the money. This is like saying that we expect rain in the Atacama Desert. We're pretty certain that it won't happen. So the deep in the money and the deep out of the money options are the ones that convey very little information and therefore they have very little value, relatively speaking. But the at the money options are the most uncertain because half of them will expire in the money and half will expire out of the money. And therefore they convey the most information, and that means they convey the most value. Now again, remember when we say the most value, it's the highest extrinsic value, not the total value. So let's jump over to an E-Trade platform and see if this is true. Okay, so now we're into the E-Trade platform. I'm going to use the S&P 500 or the spiders, currently at about 475. So look down here, we've got a expiration with 28 days to go. So the at the monies would be 475 strikes right there. So look at the extrinsic value, that's this column. And we can see that it has, this 475 strike, $6.71 of extrinsic value. But as we move to lower strikes, look what happens. We go 650, 602, 572, 547. The extrinsic value is being reduced. Why? As we go to lower strikes, like the 471 strike, we are getting less and less information about whether it's going to be in the money or not. We're relatively certain that it will be, so therefore we're not willing to pay as much for the option. Again, when we say as much, we mean the extrinsic value. Now if we go in the other direction, here's the 475 strike. If we go to the 476, look at that. It drops from 671 to 635. And then next step down, 576, 525, 463, 419. They're getting progressively cheaper. And that's because these also don't carry a lot of information. We're pretty certain that they're going to expire out of the money. But the 475 strike, who knows? That's a coin flip. And so it conveys the most information and conveys the highest price tag. Because if you buy this call, or if you buy this put, you are removing half of all of the stock prices in the future. It's either going to be above that or below it. And again, that's why the market is commanding the highest price. Now what you're going to see is that no matter which underlying you choose or expiration, that will always be true. So let's jump over to NVIDIA. So let's go to this one here with 357 days to expiration. NVIDIA is really close to $4.99. Now these strikes are in $10 increments. So we can see that the extrinsic value for the 490 is about $88.20. And then for 500 is $91.65. And then the 505 strike drops to $88.66. So the 500 strike has the highest extrinsic value. The market is pricing that one as the at the money. As we move to lower strikes, extrinsic value drops. As we move to higher strikes, the extrinsic value drops. Why? Because again, we're moving towards certainty. At this end of the range, we are relatively certain it will be in the money, and so the market's not willing to pay as much extrinsic value. At this end of the range, the market is relatively certain it will be out of the money, or that it won't be in the money, and therefore market participants are not willing to pay as much extrinsic value. But when you're right here in the center, at that 50-50 shot, the option conveys the most information, has the ability to remove half of all of those values, and therefore it commands the highest price. So even though the at-the-money options convey the most information, that doesn't mean that you always choose them. Remember, they're tools. So don't just randomly buy at-the-money puts, let's say, to protect stock positions. Why? Part of the reason is that option premiums usually annualize out to about 20% per year, whereas stock returns are in the order of about 8 to 10% per year. Instead, use at-the-money options for the right reasons. So to make the most of options trading and decisions, use at-the-money options for the times that you feel you need to remove the most uncertainty. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.